Hello, my name is Professor Avanidhar Subrahmanyam. I go by Subra, and today I'm here to present a 20-minute keynote speech on my latest research. So at this point, let me get started with my research presentation. I'm a professor at UCLA. I specialize in finance, particularly behavioral finance, although in general, I specialize in the field of investments. So behavioral finance is my particular interest. The paper I'm going to present is, in fact, in behavioral finance. So let me now share my screen with you so that we can proceed with the presentation. So as you can see, the research I'm going to present today is called Momentum Reversals and Investor Clientele. Let me try and motivate the study. So this study focuses on two phenomena in stock markets, which are called momentum and monthly reversals. Momentum refers to the fact that stocks that perform well over the past 6 to 12 months continue to do so in the next 6 to 12 months. So the history of past performance repeats itself. Okay. Monthly reversals refer to the phenomenon that stocks that do well over the past month underperform the next month. So in other words, if a stock has done well relative to other stocks this month, it tends to perform poorly the next month. Right? So you can see that there are these two competing empirical facts, momentum and reversals. Right? So what we're trying to do here is try to figure out some reasons of why these patterns might persist. Now, earlier work has focused on why momentum can arise, and really quickly, there's two categories of stories for this. One is based on rational risk, and the other one is based on behavioral biases. The risk story relies on the fact that if stocks have done well, they have more profitable projects or real options to pursue. These projects add more risk to the firm, and because they've added more risk to the firm, the required return on the firm is greater. And that's why we see momentum, right? So better past returns, more risk, because more projects are open to the firm, right? And therefore, the expected return on those projects is higher, and that's why we see momentum. The other category explanations suggest behavioral problems in investors. For example, one category of explanation suggests that there's underreaction to public information because people believe in their own information very strongly. So they underreact to outside signals, which creates momentum because prices don't react fully to public information. Now, in trying to understand which of these explanations dominate, if we had a way to control for cash flows, so have two firms with the same cash flows, so that the first explanation doesn't apply, they have the same cash flows, and then we still see momentum differentially across the two assets, then we could argue that the first explanation is less likely to apply, right? But the challenge is, can we get such a scenario where we control for cash flows, right? Continuing on that front, right? Let's now talk about short-term reversals. And with short-term reversals, the explanation generally has been that there's price pressures induced by noise traders. So uninformed traders trade actively in a given direction in a given month. Let's say they buy, then the price has to go up to compensate someone to hold the inventory of the noise traders. So the price goes up too much to compensate the liquidity provider, and then prices come back down. Similarly, if noise traders sell, the price goes down too much because somebody has to be compensated for holding the noise trader risk in the portfolio, and therefore prices have to reverse. So again, if you could get different assets with the exact same cash flows, but different noise trading, then you could test for this explanation because you would expect more reversals in shares with more noise trading, right? Okay, so moving along. So what we're going to do here is to present some results that essentially exploit the scenario. So in China, as some of you might know, there are different share classes on the same firm. For example, A and B shares are listed on the same firms, but they're different share classes. And the clientele, or the type of investor that invests in these shares are different. For example, in A shares, till recently, there were quotas so that foreign institutional investors could not participate. So A shares are generally free of foreign investors, okay, foreign institutional investors. On the other hand, to invest in B shares, you have to have foreign currency, and there are currency restrictions imposed on domestic Chinese investors, so they can't really invest in A shares, and many of them just don't. So B shares don't have retail investors. So A and B shares have the same cash flows, but A shares don't have foreign institutions, and B shares largely don't have domestic retail investors. Okay. So what we find in this work is that there's momentum only in B shares and not in A shares. And that sort of accords with more informed investors, institutions that underreact in B shares, right? So like I said, people underreact to information. So B shares have more informed investors, so there's more underreaction, so you get momentum. And as we already observed, A shares have more retail investors, so they have more noise trading, right? So we would expect to see more reversals in these shares, and we find reversals only in A shares, no reversals in B shares. We also find that in B shares, higher institutional ownership implies more momentum, which is consistent with the view that institutions cause momentum. Okay. And remember in this that A and B shares are claims to the exact same cash flows. The cash flows are not different, only the clientele is different. So this is consistent with the view that return predictability depends on the clientele holding the shares. Okay. So the outline of our theoretical argument is that basically informed investors underreact to public information, which causes momentum, and noise traders have to be accommodated. So the risk of compensating people who accommodate noise traders leads to reversals. So we have a model that sort of yields results consistent with the view, and it shows that short-term reversals should be higher when noise trading is high, and momentum should be higher when informed traders are more prevalent. Okay, so I'm not going to go to the details of the model, but there is a model in the paper that shows these things. Okay. So let's get to the empirical work. There are 3 samples that we analyze. First is a sample of firms which issue both A and B shares, right? We call this the A-B sample. And secondly, there's a sample of firms with only issue A shares. And that sample, as you can see, is much larger. Okay. So within the first sample, we have obviously those firms that issue A shares and those firms that issue B shares. That is to say that there's an A share sample and a B share sample amongst the firms that issue both A and B shares. This particular table, all it's showing is the following, that foreign institutional investor ownership, FII ownership, is much larger in B shares. That's the right column, right? And the trading volume is much higher in A shares. That's consistent with the view that domestic retail investors are largely present in A shares. And you can see the trading volume is almost 20 times higher in A shares. Okay, so let's get right down to the results. The main result in this particular slide is just that there's momentum only in B shares. So what this table is doing is computing momentum profits in the following way. It's sorting stocks into past returns performance over the past 6 months, and it's computing returns over the next month based on the sorts over the past 6 months. So W are the winning stocks and L are the losing stocks. So W minus L being positive and significant means that there's momentum. And if W minus L is not significant, it means there's no momentum, because W minus L is the return performance differential between winning and losing stocks in the next month after the sort. So as you can see, if you look at panel B and the AB sample, the B shares demonstrate momentum because the T-stat on W minus L is 3.33, significant, and A shares don't. The T-stat is insignificant. And whether we look at value-weighted portfolios or equal-weighted portfolios, we get the same result. Okay? And the sample of only A shares exhibits no momentum, as you can see as well. Right? So from this, we can see that there's momentum only in B shares. This is just a plot that if you had invested $1 in just the B shares, that's the orange line. You can see that it goes through the stratosphere to a very high number from the beginning to the end of the sample, right? Whereas the A shares in the AB sample and the only A sample don't go anywhere. So this is just confirming this momentum only in B shares. Right. So this is consistent with the view that B shares have a greater representation of informed institutional investors that underreact to outside information and thereby cause momentum. Let's look now at monthly reversals. As you can see, monthly reversals are simply sorting stocks by the performance over the last 1 month and then computing the returns on those portfolios the next month. So if L minus W is positive, it means reversals. And if L minus W is negative or insignificant, it means no reversals, right? So here you can see that only a sample has significant reversals. L minus W is very strongly significant and positive. The value-weighted sample of L minus W doesn't exhibit reversals to the same degree, but the equal-weighted sample does in terms of the A shares. The B shares exhibit no reversals, and the equally weighted sample of A shares does exhibit strong reversals. Okay, so even though this means that reversals are concentrated in the relatively smaller A shares because equal weighted yields results and value weighted doesn't, it still also implies that there's no reversals in B shares and only reversals in A shares. Right? Okay, so again, if you invest $1 in the A shares of the AB sample and the only A sample, it yields significant profits, as you can see. Those lines go off very high, whereas the B share sample yields no reversals, right? So this is consistent with the notion that we see monthly reversals only in A shares. Okay, and this is just a robustness check. We understand there can be bid-ask bounce at short horizons. So prices bouncing back between the ask and the bid can cause mechanical reversals. So we leave out the last day in the formation period month to account for this bid-ask bounce. So if you leave out a day, the bid-ask bounce doesn't matter anymore. And we find no change in the results. So again, this confirms that there's only monthly reversals in A shares. Okay, so this is consistent with the view that, that retail investors are more present in A shares and the noise traders, therefore, are more active in A shares. And so to accommodate them, we have to have monthly reversals. And this is consistent with the notion that we see reversals only in A shares, where the domestic retail investors, where the noise traders dominate. So these are some regressions, and regressions confirm the results of the portfolio sorts. So RT minus 1 is essentially the last month's return. So you have monthly returns regressed on last month's returns, and they yield significantly negative coefficients for only A shares and not for B shares, right? Momentum is only present in B shares, as you can see, that the coefficients are significant and positive for only B shares. So there's momentum only in B shares. Now, we also show that momentum is stronger in those B shares which have higher institutional holdings. So LIOF is a percentage of shares held by institutions in B shares. And RT minus 2, T minus 7 is essentially the momentum variable, the return over the past 6 months, excluding the past 1 month. Right? So you can see that the interactive coefficient of the momentum with institutional holdings is positive and significant, which means that the bigger LIOF, the more momentum there is, right? And LIOF is, as I said, the institutional holdings. Okay? So higher institutional holdings means more momentum in B shares, which is consistent with the view that institutions create momentum. There's more evidence in the paper. For example, we show that A shares are much more volatile than B shares, which is consistent with the view that these retail investors are creating volatility in A shares. We also show that reversals in A shares emanate primarily from positive returns. So positive returns reverse, but negative returns don't reverse. And this is consistent with the view that A shares, when there's a lot of buying in them, then the market makers need to go short. And shorting is costly. So the compensation required to absorb the buys will be greater. And so you'll see more reversals on the buy side. Okay. Another thing we show is that, the third bullet point on the slide, which is that only the B shares exhibit earnings drift. That is to say, underreactions to earnings surprises. Okay. So this is consistent with the view that institutions underreact to public signals, right? because they overly believe in their own assessment of the stock, and so they discount the public announcement of earnings, and so the B shares underreact. So we see this earnings drift only in B shares. Okay? So to give you the quantitative evidence, you can see from here that in 88% of the months, the volatility of A shares exceeds that of B shares. Okay? And the variance ratio, the ratio of the volatility of A shares to B shares, is about 1.5. So that confirms that A shares are more volatile than B shares. Similarly, the earnings drift evidence, like I said, as you can see, that if you sort stocks into highly positive earning surprises and negative earning surprises, right, and compute the 30-day return following the earnings announcement, you can see that the B shares underreact to the earnings announcement because the high minus low is positive and significant in the 30-day period following the earnings announcement, but the A shares exhibit no evidence. The T-stat for them is insignificant. So only the B shares exhibit earnings drift. So to review the motivation, the A shares are predominantly traded by retail investors because there are ownership quotas on foreign institutions. B shares have foreign institutions, but very few domestic retail investors because they need foreign currency, and there are currency restrictions imposed on domestic investors, which preclude them from trading B shares. Okay? So in conclusion, what we find here is that only B shares exhibit momentum and earnings drift, only A shares exhibit monthly reversals, and A shares are more volatile than B shares, and increased institutional holdings in B shares implies increased momentum in B shares. So all these findings support the argument that there's reversals in markets at the monthly horizon because we have to accommodate the trading of noise traders, okay, which are these domestic retail investors. That's why we get reversals. So we get reversals only in A shares because that's where the domestic retail investors trade. And momentum emanates from institutional underreaction to public information because only A shares exhibit momentum and earnings drift. Right? And that essentially ends my presentation. So we'll now stop sharing the screen. And so that is all I have for you. And thank you very much for listening. Good luck.